Welcome to our live stream event, our view on the economy, on markets. A lot has happened since our last live stream event in June, but at the same time, not so much has happened, it seems, because we're still asking the same questions, especially with regard to inflation, with regard to the US economy, and also one of the main topics for today we want to talk about is what's the outlook for the US economy? Do we see a hard landing, or could we actually indeed see a soft landing? It's a similar question like in June. We've got some new data, and I'm happy to share that data with you and our view on how to interpret that data and the recent news flow. My name is Felix Brill. I'm the Chief Investment Officer of VP Bank. As usual, you can ask questions by typing in your questions in the chat function. I will then answer those questions at the end of the presentation. Now, what data have we gotten, and what's the current status on the US economy? And actually, it's quite a positive observation to start with. It looks much better than expected. If we look, for instance, at a kind of a live forecast, a live estimate of the current development of the US economy, it looks quite positive. On the left-hand side, you see a chart from the Atlanta Fed. They run, it's called GDP Now. It's a forecast model taking into account the most recent data. And we've seen the first forecast for the third quarter growth of the US economy by end of July. It started at around 3.5% annual growth rate. And now, if you look at the last forecast updates since mid-August, actually it's more pointing towards 5.5% to 6% growth, which is actually quite strong and doesn't look like a recession at all. So you wonder what is driving the US economy right now. We see still a lot of positive support from consumption. We see still some pent-up demand still from the COVID pandemic, and if you look at the saving rate of households, it got a boost in the years 2020, 21, even 22, which now still is positive for the willingness and the ability of consumers to spend. We still see the labor market running okay. I'll come to that in a minute. And we see finally also a bit of a stabilization or even a slight rebound on the manufacturing sector. It has been a bit more the sector in already having some dealing with the challenges of higher interest rates and a weakening global demand. On the right-hand side, you see the ISM survey, one of the most important indicators for the US economy. And the dark blue line shows you the overall index based on that survey. And finally, we see some uptick. It's still below the mark of 50 points, so still more companies saying things look not as good as they used to be than companies saying things are improving, right? But the level of deterioration has stopped basically. It's a stabilization, even a slight turnaround. And if we look at the light blue line, there's actually we can expect that from there on there will be a positive trend, because if you look at the more forward-looking components of that survey, namely the new orders intake, and compare that to the inventories, things are improving, and they're improving now a bit faster than 3 months ago. Basically, there are more orders coming in faster than inventories are built up, or put it differently, inventories are now finally going down in relative terms to the orders, and this means there's support for future production from that, because then you have to deliver on these orders. Now, that is positive, obviously, and basically is a strong indication that a soft landing could be indeed the scenario going forward. So then we have to do the reality check on the labor market. Of course, it's not a forward-looking indicator, it's more of a lagging indicator, but still for the overall economy, very important. And now finally, we talked about that already in June, but since then it has intensified. We see more and more cracks in the labor market. If you look at the left-hand side, job openings are coming down. There's still a lot of open jobs out there, but not as much as 3 months ago or 6 months ago. And that's typically, given the nature of the labor market, it's most likely to continue to go down because it's a bit of kind of a inertia in that kind of development. And at the same token, basically, if you look at a consumer survey from the Conference Board, where consumers are being asked, how easy is it to get a job, or put it differently, are there plentiful jobs out there? And if they say yes, that's typically a good sign. And last year, still a lot of 60% of the households said, well, yes, there are plentiful jobs. This has come down to now almost 40% negative trend, and that is always also an indication that the labor market is slowing. To some extent, actually, that is good. That is what even in a soft landing scenario you would like to see, because this means then that inflation pressure is moderating, and the central bank, the Federal Reserve, does not have to add any more interest rate hikes. So there's still the potential for a soft landing. That's still on track. Definitely from a financial markets perspective, it's like from a risk point of view, it's no longer as big as it used to be. Having said that, a recession could still bite, and there's still some challenges ahead for the US economy. Interest rates are still elevated, and this is dampening demand, and it is always a difficult path towards that softening of the labor market, softening of the overall economy. It's not a given that this continues to go smooth, but there could be a bit more bumps ahead of and obstacles ahead of in the road, and so we think still it's very likely that we see indeed a recession. So in 2024, of course, it has been postponed, but it's not kind of taken away completely from the table. So we still think, even though that the US economy is doing quite well right now, third quarter looks good. The labor market, it's still running okay, but it's deteriorating, it's weakening, and this will continue. And at some point, I think my colleagues are thinking that we still heading towards that recession. And because we see already from other regions in the world that all these challenges like higher interest rates, that these challenges are starting to bite and hurt. If you look, for instance, to China, or if you look to Germany, and with that to Europe, the real estate market does not look good at all. You look on the left-hand side in that chart for China, you see the building activity is negative compared to the previous year, which is not good for the overall economy. And if you look at the IFO survey, which is one of the biggest surveys in Germany from the IFO Institute in Munich, and if you focus there on the construction sector, the business climate is as weak as beginning of the COVID pandemic, and it has never ever been that weak, except for these two basically times since 1991. Shows really that the German economy is facing a severe slowdown. It's not just a soft landing slowdown, it's a severe slowdown. You see that also in the manufacturing industry, and now finally also in the service sector, things are starting to deteriorate. And against this backdrop, it might not be a surprise that the German Chancellor, Olaf Scholz, kind of really called for a national coalition, basically, to revitalize the economy, growth pact for Germany. And if politicians call for such a national coalition, then typically things are not looking that good. And I think that is also a bit of a glimpse to the future for the US economy. Things are most likely to deteriorate from here. Now, for financial markets, the takeaway is it's not a straightforward one. For the time being, it's definitely positive that the US economy is being robust, and that has supported quite a rebound in US stocks. It was also supported, that rebound, by the hype on artificial intelligence, especially tech companies or companies like NVIDIA, really kind of benefiting from artificial intelligence, from that big trend. They have had a really good run. But we've seen also that on the right-hand side, if you look at 10-year government bond yields for treasuries in the US, that they started to increase again in August. And with that also, looking back on the left-hand side, equity markets had a bit more difficulties, because if interest rates go up, it's a bit of a challenge. If for valuation of companies, you have to discount future earnings, especially in the growth sectors and tech sectors. There's a strong relationship between higher interest rates and lower valuation. So that it takes a bit of a break and a challenge for equity markets. Now, the challenge is going forward to find really now the right balance. So let's assume we really go for the soft landing, but maybe it's even not soft enough, right? Or like too soft, how you would like to phrase it. So if we continue to see really strong economic data, a strong labor market, and a rebound really in the manufacturing sector, and so on, this might not be really that positive actually for equity markets, because then there will be additional questions raised in terms of the inflation outlook. We've seen yesterday with the most recent data for August that inflation went up again to 3.7%. Of course, core inflation came down, but headline inflation went up. And the stronger the US economy is, the more likely it is that inflation becomes sticky. And with that, the Federal Reserve might be forced to add additional rate hikes, and that we've learned in the last 1.5 years. If that narrative changes, that's typically not good for the equity market. So if economic data comes in too strong, that might be difficult. If finally economic data turns sour, this might also be a bit of a challenge for markets, because then a positive outlook on equity markets, it's a bit more difficult to support. Now, so basically what we need in order for that run in equity markets to continue, at least in the US, you need more fantasy with regard to artificial intelligence, and you need kind of a perfect balance, a perfect mix of incoming data, not too soft, not too strong, and inflation kind of moderating. That can happen, but there's no guarantee that it is going to be a smooth ride, and we would expect even for the next couple of weeks that this might be from time to time a bit more bumpy. And if we indeed see a change in sentiment, that could be actually a good timing then for adding exposure, but we don't want to chase the rally in US stocks right now. What we decided this week in our investment committee in general to continue with our overall cautious stance in the portfolio, meaning we are underweight equities, overweight bonds, overweight money market. But we are reflecting this, that there's more strength, taking into account that there's more strength, underlying strength in the US economy, that there is a potential path towards that soft landing. There's not a probability of 0 for that. And with that, basically, we decided to reduce our equity underweight somewhat. We did it if you look at the Swiss franc portfolio as a reference point, we basically closed our underweight in Swiss equities. If we look at the euro portfolio, we closed our euro equity. No, we reduced our euro equity underweight there as well. So basically, building on our investment philosophy, typically if we get new information, do a step-by-step approach, a gradual change in the portfolio stance, and trying to avoid the extreme swings. Of course, if there is a huge setback in market, if there's a sell-off, and then that could be a good time to increase more exposure at a given time. But as long as there's no guarantee that we see that sell-off. And so therefore we take the development of the last couple of days and weeks into account, and decided this week to do a first gradual step towards a bit of a higher equity quota, but not closing the gap completely because there's still some obstacles along the road, and the ride could become a bit more bumpy from here. And there's no guarantee that we see a year-end rally without any turbulence. With that, I would like to close my quick view on the economy, on markets, and focus on your questions. I see 2 questions coming in. The first one, what's your view on the dollar? I did not touch on currency so far. That's right. On the dollar, it's changed a bit most of the year. We thought there is more potential for the euro, for instance, especially if you look at euro-dollar pair, that there's more potential for the euro stemming from the fact that the ECB has to do more than the Fed. The Fed started earlier to increase rates, so there was more upside on the ECB in terms of increasing rates, and that is typically, at least in the short term, can be positive for the currency. We've seen euro-dollar moving up in the last couple of days. Now we've seen a bit of a consolidation. Now with the ECB today meeting, we expect another, probably the last hike, at least for the time being, before the ECB also focuses more on the incoming data, becoming more data dependent. And with that, basically the upside potential, the surprise potential from the ECB is fading. And with that also potential support for the euro is fading. And for that reason, we now kind of expect euro-dollar to move sideways. And with that also Euro-Swiss and dollar-Swiss basically is kind of in the same perspective. So there's not, we don't see a lot of potential in the short term for big swings or like that. There's at least in the major currencies, if you look at euro, dollar, and Swiss franc from our perspective, that there's huge potential from one of these currencies. The conclusion maybe from that is that, as usual in our investment philosophy in a discretionary mandate, we hedge the main currencies, not only in the fixed income side, but also on the equity side. So let's take a Swiss franc portfolio. We hedge the currency for US equities, we hedge European equities. And with that, basically, from a Swiss franc point of view, we benefited from the positive development of equity markets so far this year without having the burden of the weakening of the dollar and the euro vis-à-vis the Swiss franc, so which was performance-wise quite positive. Now, another question, what do you expect from the S&B next week? Yeah, the S&B is meeting only once a quarter. The last meeting in June, they hiked in June. And now the next meeting, the first meeting since June is now this next week. We expect that the S&B is doing another hike and then also changes to a wait-and-see mode. The S&B is in a kind of a comfortable situation that inflation is much more controlled, contained. In Switzerland, it's below 2%. And so there's not the same need to do the same level of interest rate hikes, amount of hikes like the ECB and the Fed. So the S&B is in a kind of a comfortable position now, that they also tighten the monetary policy to counter potential building of more inflation pressure. The Swiss franc has strengthened. It's also positive for the Swiss National Bank because this limits the imported inflation, and with that there's not so much need to do much more. So we also expect then that the S&B after next week joins basically the camp of wait and see, follow incoming data, and then decide from meeting to meeting. With that, I see no more questions. If you have any more questions after this event, please feel free to reach out to a client advisor or drop me an email. I'm happy to answer your questions. And if I don't hear anything from you, looking forward to our next live stream event or to a meeting in person. And until then, I wish you a very good time and take care. Bye.